Hello, and thank you for tuning in. In this post, we're going to consider one of the most important and underappreciated factors in determining how long your nest egg may last. In doing so, we will also challenge some of the traditional ideas about portfolio management in retirement. Specifically, there are two popular spending strategies that are widely perceived to be sound. The first involves the notion that retiree portfolios should become more conservative as they grow older. To implement this strategy entails basically spending down the stock portion of one's retirement portfolio first and leaving the stable bond portion of the portfolio to protect against market risk later in retirement. The second strategy, which is almost universally illustrated in retirement planning software these days and which remains popular in the financial planning community, involves spending proportionally from each asset class and rebalancing to maintain a constant allocation throughout retirement. This allocation is typically somewhere between 50% stocks and 50% bonds, or 70% stocks and 30% bonds, somewhere in that range. In this presentation, we'll examine a progression of withdrawal strategies. We'll begin by illustrating the aforementioned stocks first and constant allocation with rebalancing strategies. Next, we'll consider a variation of the constant allocation with rebalancing model that incorporates a simple decision rule that instructs the retiree to refrain from selling stocks following down years. We call this approach a guardrail strategy. Lastly, we'll consider the opposite extreme of the stocks first spending approach by illustrating a bonds first spending strategy. For illustration purposes, we will apply our analysis to the following standard portfolio model design. As you can see, we're illustrating the model over a 30-year time horizon, and we're using a $1 million portfolio as a nice round number for illustration purposes. We're also using a standard 60-40 stock to bond allocation. To generate our analysis, we enter the basic input data from the model into our retirement stress testing software. The software employs a simulation methodology called bootstrapping that involves random sampling of monthly return data from 1970 to 2014, which basically covers the modern era of the stock markets. So it's not historical backtesting. This random sampling method allows us to produce some simulation results which are pretty ugly, and that's what we're trying to test, basically testing from the median results to the worst. After entering the data from our model design into the application, the final input allows us to illustrate each of the 4 withdrawal strategies we are testing. After each simulation, we then went back and left all other input variables the same, but changed only the withdrawal method. The output from the 5,000 simulation results that were produced for all 4 withdrawal strategies is summarized in this table. The portfolio values represent the remaining balances at the end of the 30-year time horizon from the median simulation to the bottom 1% result. In other words, for stress testing purposes, we're considering only the bottom half of the simulations. It's important for viewers to understand that these results do not represent probabilities, and they're not intended to be predictive at all. Instead, the results show how each of the 4 strategies might fare under adverse conditions. That's pretty much what the investors need to know, yes? As you can see, the results in this table serve to highlight the importance of the withdrawal strategy in determining portfolio sustainability. In particular, the values presented strongly suggest that the widely held consumer belief that retiree portfolios should get more conservative, that is, more bond-weighted over time, may be naive, and that following such approach may be seriously detrimental to both wealth and the prospects for sustainability. Equally noteworthy is the observation that constant allocation with annual rebalancing may lead to significantly worse outcomes than the simple guardrail strategy that was presented, as well as the bonds first strategy. While we expect that the findings in this table may be surprising to some viewers, they are consistent with other published empirical research over the past decade. In closing, the purpose of this presentation has been to illustrate the importance of the choice of withdrawal strategy in determining how long your nest egg may last. We hope you found this informative, and thanks for watching.